Robinson here from Mortgage Choice over in Noosaville. I wanted to take a couple of minutes today just to talk to you about guarantors. There's an ever-increasing prevalence of people who are looking to use guarantors for their loans, particularly those young first home buyers who may find it difficult to save deposits. I just wanted to go through it a little bit with you on the board there so that you know exactly how it works. Under a normal arrangement, if people want to buy a property, say for example, let's use $500,000 as a round figure, then normally they have to save at least 5% of the purchase price and also cover some costs on top of that. So there's normally about $25,000 to $35,000 that are needed in order to move in to that property to settle. And that can be quite an onerous task for some first home buyers to come up with. So there are another number of options that you can use, and one of them is you could get a gifted deposit from somebody, most typically mum and dad, who can do that. But sometimes they not be in a position to do that. So they may be in a position though where they have equity in their house that you can use as a guarantee arrangement, which you can help you then move into your house. So basically the way it works is just like this. Say for example you've got your house worth $500,000 that you're looking to buy. You don't have the deposit for that typically as a person who's using a guarantor. So really what you can do then is use, in this example, let's say mum and dad's house. So let's say they've got a house that's worth $400,000. So you can potentially then borrow the whole amount of money that you require in order to buy this $500,000 house. So let's say that house with stamp duties and all that sort of stuff is going to cost you around about $510,000. And that's how much you would need to borrow. So what the bank will do then is they'll allocate the loan apportioned to the properties that the guarantor owns and that you will own as well. So they'll take a loan over this property here, and they'll take a guarantee loan, which is normally equal to around about 20% of the amount that you're going to borrow. So let's say $102,000 here as a guarantee against your parents' property. It's what's called a limited guarantee. So if ever anything goes wrong with the loan and the bank has to sell you up and foreclose on you, God forbid, and they lose money on that transaction, then they can potentially then go to the guarantor and gather any shortfall from their property, but only up to the value of that limited guarantee, which is $102,000 in this case. So no more. So in the old days with guarantees, they weren't limited, and guarantors were at risk of losing the entire amount and potentially wiping them out. So it's still a risk for guarantors, and it's something that you need to talk about those people who are going to guarantee in great detail, because it does affect future borrowings if they want to borrow, and it also does affect their borrowing capacity as well. So the guarantee can ultimately be removed from this property in the instance where A, there is a growth in value of the property. So the property grows in value sufficient to take that away and put it back over here. Or a cash injection, should you come into some money and pay this loan down, you can move the guarantee back over here and release the parents, in this case, off the property. Guarantors typically should be working. There are a couple of banks who will still let you do guarantors if the parents are retired. They normally need to be family members or siblings who can provide the guarantee. In many cases, and let's say most really, they should receive independent financial and legal advice to let themselves know exactly what they are getting in for, because there are risks associated with providing a guarantee to you. It doesn't matter in some instances whether there is a small loan on the property, because the bank who takes the guarantee can take a guarantee on top of whatever loan they might have with another institution in this case. Ideally, there should be enough equity there left so that it doesn't put these guys here at risk. And normally the bank will only provide a guarantee up to a level of 80% of the family members' property, so that they don't suffer any hardship or need to go into mortgage insurance territory. So the benefits of the guarantee are that A, you don't have to have a deposit with you. If you do though, it's always a good idea to put that into the transaction. You don't have to pay any mortgage insurance where you would normally if you've got only a 5 or a 10 or 15% deposit. So that large fee, in this case it would be somewhere around $12,000 or $15,000, is not applicable. And it allows you to borrow the whole lot and keep any cash you've got in order to do any renovations or work or buy stuff for the property that you want. So if you are in a position where your family members are able to and willing to give you a guarantee, it's something you should be considering in that instance if you wanted to go down that track. But talk to us about that whenever you've got a moment and want to chat about it. We're always here to help you, or on email. So any questions about guarantees, give us a call. I'm Ian Robinson from Mortgage Choice. Nice to talk to you.